Hi. So it's tax season and everyone's thinking, I gotta do my taxes. I was at breakfast and I heard the one cook talking to the other cook. He said, yeah, I'm gonna have to send in a third. I have to work till, some specific month of the year just to pay my taxes. We've all heard that. But he said, I'm gonna have to pay $20,000. And so afterwards I talked to him, he makes $62,000. His wife's disabled. And I was like, you don't have to pay those taxes. You have some things you can do. So I just want to make this video for you guys. If you are used to paying lots of taxes and you just work at a job and you always pay taxes, I don't know how you don't know this, but I want to make sure you know this and you share with all your friends, okay? So this is how you don't pay the IRS all your retirement. You pay it to yourself in an IRA. So we're going to call this... call this tax season. And you can pay the IRS or an IRA. And how this works is, I just looked up the median income. It's on census.gov. It says it's 68,000. We're just going to use 60,000 for easy math, okay? So we're going to say if you're making 60,000 a year, in both cases, if you work all year and end up paying a third, we know that's 0.33 and that's $20,000, right? So you're gonna pay $20,000 to the IRS. And how long are you gonna be doing that? Well, most people, they get a job at least 25 and they work to 35, 45, 55, 65. So you got 10, 10, 10, 10. So we're talking 40 years. Okay, so you're gonna do this times 40. What's 20,000 times 40? Here's the easy trick. 2 times 4 is 8. Add up all the zeros. It's really that easy. So 1, 2, 3, 4, 5. We got 8. 1, 2, 3, 4, 5. Stick in a comma. Okay, now you're fast at math. So you're gonna pay $80,000 to the IRS. That's a lot of money, and that's just year after year adding it all up. Now they'll be compounding it and making interest on it, so this might turn into 2-3 million. Let's do that in your account. So if we can take the same 20,000 times 40 years, and if we can shift it, put that money into your account, let's shift it over here. And let's say, well, here's what's going on. So if you don't put anything in an IRA or a 401k or whatever your thing at work is, your pension for your own business, you have no savings. And let me just pause to say this. Your grandparents told your parents, just get a good job, blah, 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 blah. You've heard it a million times. And why did they say that? Because companies used to be diligent, have integrity, and save for you and not be beholden to the shareholders because of the new model that we have in the stock market. So now they literally and legally are beholden to cut out as much fat as they can, health insurance, employees, benefits, life insurance. I talked to so many people that thought they were good after they retired from ABC company, only to find out their life insurance was annual renewable term and the $1 million or the 100,000 they thought they had, and now at 75 is worth like 30,000 of coverage because they were allotted a monthly $100 a month or $300 a month usually, and that buys less as you get old. So the 150,000 they think they're leaving to their wife is nothing unless I catch them at right at retirement and get them a permanent policy. So if you know anybody that's about to do that, please have them talk to you. All right, so IRS versus IRA. You're making 60. You're paying a third to the government. That's going to go on for your whole working life. 800,000. Now what you can do here, instead of paying 20,000 a year to the government, you can do, they'll let you subtract anything that you save for your own retirement so you won't be sucking off of the government, which was never meant to support you. So they'll let you do an IRA, and that can be many different flavors. So that can be usually $6,500 into an IRA if you're 50 or under. If you're 50 or above, they'll let you do a catch-up on that. But let's not talk about that. Let's just talk about the main flavors of ice cream. So you got an IRA, you got a 401k, This could be a 457 if you work for the government or a teacher or firefighter or cop, city employee. And it can also be a 403B if you work for a nonprofit or have your own nonprofit. So you're allowed to put into this $19,500. As long as you make under a certain income limit, there's a cutoff. They do cut you off. I think it's about $185,000. But if you take your $185 and subtract this and this, now you show less. But for this guy, he can put what's that? 19 and 6 is 25 plus another grand. So this guy can put away $26,000 a year. And then if you're over 50, they have what's called a catch up, because most people really don't start saving until right around here, age 40. And they're like, oh my gosh, I gotta get started, right? So you can write off $26,000 a year for yourself instead of giving it to the IRS. So let me go on this side. So you can either give it to the IRS or you can give it to yourself in your IRA. And that's what I recommend. How do I get that done? Well, you just think about it every single Friday and do it. No, you're never gonna do that. I've seen nobody ever do it. You have to set up what's called autosave. So you see all these videos about life hacks. You have to hack your bad habit of not saving. Don't worry, everybody's bad at it. Usually a guy or a girl will marry the opposite. You have a saver and a spender in most cases, but you have to set up autosave. So if you take 26,000, divide that by 52, whatever that comes out to be, that's what you need to do. In a little rhyme, if you remember from high school, 451 Fahrenheit was a book we had to read where they burned all the books. Well, 451 a week will hit your 401k's peak. That's how I remember it. So for this, you're gonna wanna auto save 451 a week out of your check. And then for this, whatever that comes out to, 52, so it's like 100-ish. I don't know, maybe it's 115 a week. So basically, you need to make enough money so that 566 a week comes out of your check on autosave, okay? So we want to do autosave for you. Otherwise, you're just going to give this $800,000 to the government. That's how it works. So that's really simple. I just want to keep this short, brief, and powerful. If you're not auto-saving, you will have nothing at the end. That's how it works. You will have given a third of your income to the government, and this number is probably going up. So if you're new, just call me and let's get an appointment set up. We'll get you a free fact finder, go through your life, see where we can fix and improve. And if you own a business, now we're going to talk about businesses. Okay, so you're working hard and it's tax time. So let's just say most businesses under the $10 million annual income are family owned. They don't have systems. They're not organized, really don't have advertising figured out, but they're making some money. I can do business coaching and take you to the next level. Should be able to make you an extra $500,000 the first year if you sign up for our business coaching program. So ask me about that. But let's just talk about your taxes. This is a red hot topic right now. We want to talk about how we can affect this. So, obviously we just talked about now versus new in the 401ks, but as the business owner, now you can, instead of paying a bunch of taxes over here, you can set yourself up as a highly compensated employee in HCE. And let's say in this case, it's the man that owns the business. Let's say the wife is not involved or is involved. We can do it either which way. So what happens is you're going to have if we set a 401k up for your business, we can have a different limit where we are allowed to put more back for you. And then you'll have the regular, so you might be able to put, let's see, So Safeharbor 401k, you probably have your 19.5, her 19.5, and then as the business owner, you can do what's called a Safeharbor 401k, and you can match yourself. So what did it come up? It came up to 30, I think it was 34,000 each that you're allowed to put in here, max it out. So, this would be your match. And, but then you have like employee 1, employee 2, 3, 4, 5, 6. So whatever their income is, let's say that, wife's making 200K, husband's making 200K. It's usually the max out line. And this employee, let's say this employee is making 60. Let's say they're all making 60 just to keep it easy. And we can run a full illustration for you if you're ready, okay? But if they're each making 60 and you're gonna match them up to, if your match is 3%, then 60,000 times 3, 6 times 3, you're gonna match them up to, I think 1,800 all the way down here. Okay, so what you'll do is, let's see, 10,000 times 3%, 300 times 6, 1,800. Yeah, so what you'll do is you'll have some money that you pay here, but this money that you pay to the employees can be used to motivate them and say, look, we're gonna match up to 3%. That gives employee loyalty. First thing people look for is health insurance when they look for a new job. Second is 401k, and you're one of the few people that's gonna have one with a match. You're gonna win that bid if you're trying to get talent. And stop running everything yourself, because if you're a 10 million or under business, you're probably running frazzled, right? You don't have systems, employees, your managers aren't you can sometimes count on them, but you have to go in a lot. So we want a system where you can just walk away, but that's offline. Anyway, so you can match yourself this way. You're gonna be able to get 34. So together, as a couple, you get to write off 68,000, and that's just a 401k. We have some other things we can do that let you put up to 230,000. If you're 50 and up, 55 and above, I can do about 350,000 a year per spouse. So we can make 700,000 a legal tax deduction for you. But this will save you money. Instead of paying it to the IRS, we just set up a Safeharbor 401k, and you can still contribute for this up to, as I understand it, up to April 15th. So if you'd like to get this done, let's get on top of it. And then above and beyond that, there's some really interesting defined contribution plans, because our parents used to work for a company and they would define the contribution at the end of their retirement, what it would be, and be responsible saving big chunks back to have a pot of money that spun off the interest so they could get the interest checks. So our whole goal is to get you a pot of money that we can then turn into a pension. We shop the market, find out who's going to pay you an extra $1,000 a year, and then we go with them. So we do that service for you as well. If you know anybody that's about to retire, tell them never to sign the papers until they've used our pension shopper process, okay? Free service. All right, well, that's pretty much it. I think I want to keep it short, brief, and powerful, but if you're a business and you've already done this for a couple years, right now, let's say you sold your business, you're retired, and now you're at this place where like, oh, well, I already have $1 million, and Biden's, the Trump tax laws are about to expire, right? About to expire. Now, what am I going to do with my $1 million? Well, you might want to meet with our tax attorney and ask them as a third party, and then and usually what the answer is it's going to boil down to a Roth conversion. So if you have $1 million saved up in your IRA, and then your husband or wife has $1 million from the buyout of the business, say you sold it for $2 million, you each put, during that time you have the cash over here. You probably have a cash bucket. Let's just say you have 500,000 in there, and you know what we'll do? We'll just say you each have 500,000, $1 million to work with, and then 500,000 in cash in a brokerage account or some other IRA. So we're going to make sure you leave this liquid And then what we want to do is we will convert this IRA, which is pre-tax, growing tax deferred, but when it comes out, do you think taxes will be lower in the future or higher? Exactly, they always go up. So let's just go ahead and start let's start shooting some bullets out of here. Let's start like a 5 pay or a 7 pay out. And we'll take this 500,000 and we'll do 100, 100, 100, 100, 100. And we'll bring that into the light of the IRS, and we'll pay taxes here, 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 here. You're going to just pay a little bit of taxes each year as we convert it to a Roth. And then, you know, if that's, say that's 25%, hopefully in your retirement's a lower amount, but whatever it is, let's say you end up with 80,000, 80, 80, 80, 80. Now all this growth is tax deferred. All compounding interest inside is now tax deferred. It's still tax deferred over here, but when you take the earnings or withdrawals, those are tax-free and tax-free, versus over here, once you pull them out, you're gonna have to pay taxes at the higher tax bracket. So doing a Roth conversion on your 500,000 and her 500,000 would get your $1 million that's taxable now converted at the lowest tax bracket we're probably ever gonna see. Because when Biden gets in there, and when these things hit in 2025, it's probably gonna get atrocious, if not sooner. So this is what we're doing usually is a Roth conversion, and then we'll use your cash to pay some of the taxes that have to be paid. So you'll have this cash bucket to pay your 1, 2, 3, 4, 5 taxes, okay? So if you'd like us to run some numbers, do some work for you, we're happy to do that. Just hit the button below. You can private message or schedule an appointment. Thank you. I hope this was beneficial. Please share it with your friends, okay? Thanks.